Goods and Services Tax is the greatest reform held in our country, which has its implications on several sectors and the economy as a whole. Let us discuss some of the crucial aspects regarding the Goods and Services Tax, which are the need for the day. Taxation is one of the essential and decisive element in the working machinery of a nation. The revenue collected in the form of tax is used for providing various services to the public, such as infrastructure, transportation, sanitation, and other amenities by the government of a country. There are two types of taxes levied in India. The first one, direct tax, which is levied directly on the income of an individual, where the tax burden cannot be passed on to any other person. The second one is indirect tax, which is levied indirectly on the ultimate consumers of goods and services. Hence, the direct tax is levied on the income while the indirect tax is levied on goods and services. In indirect tax, the immediate burden is on one person and the ultimate burden is on another person, that is, the person who ultimately consumes. GST was rolled out in India on 1st July 2017. After many deliberations and discussions, it was decided on that date only. GST is one of the greatest tax reforms held in India. With the introduction of GST, India has joined the club of the status of India has raised and it has joined the club of developed and progressing nations. The nations in this club are already having a common tax on goods and services. In this way, the GST has uplifted the status of our country. GST Council, GST Tax Council. This council is the implementing authority of the GST. Article 279A was inserted by the Constitution Amendment Act 2016, that is the 101st Amendment. So the 101st Amendment pertains to the establishment of the GST Council. Accordingly, the President shall constitute a council within 60 days from the date of commencement of 101st Amendment. So 60 days is there for the President to establish. So this council consists of one chairperson who is the Union Finance Minister, and its members comprises the ministers nominated by the state government, whereas the vice person can be chosen by the members amongst by themselves. Goods and Services Tax Council shall make recommendations to the Union and the state regarding these aspects. The tax, cesses and surcharges levied by the Union, the state and the local bodies, which may be subsumed in the Goods and Services Tax, is recommended by this Council. It also recommends the goods and services that may be included in the GST and which can be exempted from the GST. It also specifies the threshold limit of turnover for exemption from the goods and services tax. It also suggests the rates include the rates of GST including the floor rates. It also suggests to levy some special rates for a specified period in order to raise some additional fund which is essential for meeting the natural calamity or the disaster that happened in our country. Goods and Services Tax Council shall recommend the date on which tax can be levied on petroleum, crude, diesel, natural gas, aviation, turbine fuel, uh, which is so far not included under the regime of GST. Then the GST Council will held a meeting whenever the need arises, and the quorum for that meeting is at least one half of the total number of members should be present. Every decision in the GST is taken by a majority of not less than 3/4 of the members present. The GST Council shall establish a mechanism to adjudicate any dispute between the Government of India and one or more states and between two or more states with regard to the implementation of goods and services tax. Compensation to states for deficit in taxation. The Parliament shall, by law, provide for compensation to the states. While introducing this goods and services tax, sometimes some of the states may incur deficit when compared to the tax revenue they gained during the before the GST implementation, and that has to be compensated. The Parliament has ensured to compensate that sort of losses arised to the states on account of implementation of the GST. This compensation is restricted to a period of 3 years. Parliament has passed the law to compensate the states for revenue deficit. The act is GST Compensation to States Act 2017. Under this act, additional tax is collected. How a question might arise in our mind that how this can be compensated by the Parliament, or out of which fund this compensation can be extended by the Parliament. Here is the way for it. The Parliament has passed the law to compensate states for revenue deficit. The act is GST Compensation to States Act 2017. Under this act, additional tax is collected as GST compensation cess on specified goods, and the amount is distributed among those states incurring revenue loss due to the introduction of the GST. Administration of indirect taxation in India. India is a federal country where both the central government and the state government have been assigned the powers to levy tax and to collect the tax through respective legislations. So, the Parliament can frame a legislation to levy and collect the tax. Similarly, the state government is also empowered to levy and collect tax by passing legislation. To empower the center and the states to levy the tax and to collect the GST, four legislations were approved by the President. They are the Central GST Act 2017, the Integrated GST Act 2017, the GST Compensation to States Act 2017, and the Union Territory GST Act 2017. Taxable event. The crux of any taxation system is the incidence. Depending upon the incidence only, the taxation is charged. The incidence here is the point at which the liability to charge the tax arises, and that event is referred as taxable event. The taxable event in GST is the supply of goods or services rather than sale or manufacture or production of or provision of goods and services. The concept of supply. Supply, only the supply of goods and services is levied to tax, and not the production or sale or distribution or anything is not included in the GST. And so the crux of GST is held on the concept of supply. Now we'll see what are all considered as supply and what is not considered as supply, because the supply is the determinant for tax liability. Supply is a taxable event under GST. The term supply is characterized by the following features. Supply should be of goods or services. Anything which is not a goods or services is not a supply. Only movable property is considered as goods. So immovable property like buildings are not considered as goods here, cannot be supplied, are not considered as supply for the purpose of the GST. Supply includes the flow of money from a third party on behalf of the receiver. Supply should be made in the course of business. If somebody lends his book to his friend, it cannot be a supply because it is not the business of that person. Supply should be made by a taxable person. Taxable person is one who is registered or who is liable to be registered under the Act. Any person who has registered under the GST is termed as taxable person, and only the supply made by a taxable person is considered as supply here. If the supply is made between both non-taxable parties, then it is not leviable to GST. So the supplier is not a taxable person and the recipient is also not a taxable person, then the GST is not charged on them. Then supply could be made to a non-taxable person. So if the supplier is a taxable person and the consumer is a non-taxable person, even then it can be treated as a supply. And the goods which can be considered as supply are given in the schedules. There are 3 schedules. The first schedule comprises those items, those transactions, even without consideration, are considered as supply. For the supply, consideration must be sufficient. Even in the absence of consideration, certain transactions are considered as supply. They are listed under the Schedule 1. They are deemed supplies. They are referred as deemed supplies. And Schedule 2 lists down those transactions which are treated as supply or of goods or supply of services. So whatever comes under the Schedule 2 will undergo the charges levied by the GST. Then Schedule 3, it lists down various transactions which are not considered as supply. So they are completely away from the GST. So Schedule 2 consists of the supply of goods and services which undergo the GST, and Schedule 3 doesn't are not considered as supply, and so they are not levied under the GST. Whereas the Schedule 1, even they are considered as supply, deemed supplies. They are also undergo the GST. And these are all very few concepts, basic concepts we discussed today also has to get a foundation regarding the goods and services tax. And I extend my thanks for your patience listening so far. Thank you.